Okay, let's dive in. Welcome back, everyone. Today we are tackling, well, a really interesting situation revealed in the latest Q3 2025 company update. It's a bit of a paradox, actually, with the financial summary, the detailed 10Q filing. And on the surface, these sources paint a picture of incredible success. We're talking record deliveries, record cash flow, huge growth numbers.
Right. But that's just one side of the coin. Our job here, as we dig into these documents, is to understand maybe the strain behind those headline figures. We're trying to piece together why these massive operational wins are happening alongside, well, significant pressure on traditional profit metrics. It really looks like a conscious strategic move, trading today's margins for what they hope is dominance in future tech.
And that success side, you really can't understate it. Q3 2025 revenue, total revenue, hit $28.1 billion. That's up 12% from last year. I mean, that's serious top-line growth.
It really is. And look at the cash situation. It's booming. Free cash flow, nearly $4.0 billion. That's up a massive 46% compared to Q3 last year.
46%, wow.
Yeah. And they added, what was it, $4.9 billion just in the last quarter to their cash and investments. So now they're sitting on $41.6 billion.
That's a huge cushion.
Huge. Plus, you mentioned the record vehicle deliveries worldwide, record energy storage deployments too. Operationally, almost everything is pointing up.
Which makes the profitability picture so, well, jarring. You have this surge in revenue and cash, right? But then GAAP operating income, that's the key profit metric here, it dropped 40% year over year. Fell to $1.6 billion.
That's it. That is the core conflict, the paradox you mentioned. And that huge drop means the operating margin is down to just 5.8%. Now, putting that 5.8% in context, that's a fall of over 5 full percentage points in just 1 year. That's substantial.
5 points.
When you see numbers like that, strong revenue, strong cash, but that kind of margin erosion, it's usually not just bad luck. It signals a deliberate choice, a strategically accepted consequence, you could say.
Strategically accepted.
Is that just a nice way of saying, we spent too much or we weren't efficient enough? I mean, a 40% drop in operating income is still pretty massive. What in the 10Q specifically tells us this spending is, well, prudent investment and not just overspending?
That's a fair question. You have to look directly at where the money is going. The main culprit for that squeezed margin is R&D spending, and it's heavily skewed towards AI projects. Operating expenses jumped significantly, but R&D specifically, it surged an incredible 57% in Q3 compared to last year. 57%.
Wow.
They were pouring billions. The total R&D spend was over $4.6 billion into building out the AI and software platforms they clearly believe are the future revenue engines, the things that will drive growth in, say, 5 years.
Okay, so that's the internal decision, the investment piece. But the sources also talked about external factors hitting the bottom line too, didn't they? They did, yes. There are definitely external headwinds playing a part. They specifically mentioned a higher average cost per vehicle, partly due to new tariffs, a direct result of shifting trade policies, and also lower absorption of fixed costs for certain models. Plus, some of the financial tailwinds they used to enjoy are fading.
Like the regulatory credits.
Exactly. They recognized less revenue from those automotive regulatory credits this quarter, and also lower one-time revenue from full self-driving compared to Q3 last year. Those credits used to be, well, almost pure profit margin boosters, and that effect is definitely shrinking.
What's really interesting, though, is how they tie it all together strategically. The company is very clear in the documents. The long-term plan is still about scaling core hardware deliveries, cars, batteries, because these physical things are what enable the future value from services powered by AI. It's like they're saying, we'll accept lower profit now to build the platform for much higher profits later.
That's precisely the narrative. They're prioritizing growing that installed base of hardware, the vehicles out there, the energy storage units connected to the grid, because that physical network is the foundation, the necessary ingredient for all the future high-margin software and services they plan to sell.
Okay, let's zoom in on the automotive segment then. The operational numbers were a bit mixed, weren't they? Deliveries, 497,099 vehicles, good number, up 7% year over year. But then production was actually down 5% to about 447,000 units. So if they're scaling the platform, why produce fewer cars than they delivered? What's going on there?
Yeah, that gap is telling. I think it points to a couple of things. First, clearly a really intense focus on managing inventory. It looks like they prioritized selling down existing stock to hit those delivery targets rather than pushing brand new production out, maybe given some uncertainty in the broader economy.
And the inventory number itself backs that up, doesn't it? I thought that was one of the most striking figures in the whole report.
Absolutely striking. Global vehicle inventory, measured in days of supply, dropped like a stone, down to just 10 days in Q3.
10 days.
Yeah, remember it was 24 days just the quarter before Q2 and 19 days this time last year. So 10 days.
Yeah.
They are moving vehicles almost as soon as they're ready, or they sold through almost everything they had.
Suggests really tight control over capital, making sure cars aren't just sitting around depreciating. Helps that free cash flow number we talked about, even with the margin pressure.
Definitely. And to keep those delivery numbers up, especially now, they're making a big push on affordability, aren't they?
Seems like they have to,
Ah.
especially in the U.S. after the EV tax credits changed and didn't apply to some models anymore. So they launched those new standard range versions of the Model 3 and Model Y.
Right. The Model 3 Standard starting at $36,990, the Y Standard at $39,990, both still offering over 300 miles of range. That's a clear move to make the cars accessible to more people, to maintain that delivery volume after the credit shifted. It's a necessary adjustment.
And we're seeing targeted moves elsewhere, too, like that new Model YL in China. Longer wheelbase, 3 rows, 6 seats, clearly designed for that specific market.
Yeah, tailoring the product. And they also highlighted South Korea becoming their third largest market globally. So the international strategy seems to be working in places.
But whether it's the new affordable model, the China-specific one, or even the super-fast Model Y Performance doing 0-60 in 3.3 seconds, the underlying message is the same, isn't it? It all feeds back to the AI strategy.
It does. Every single vehicle they deliver, regardless of price point or variant, is built with the hardware for full autonomy. So whether a customer buys it for the price or the speed, they're essentially adding another node to this future autonomous network. It constantly reinforces that long-term AI play.
Okay, the vehicles are the foundation. But let's talk about where the vertical scaling is really dramatic right now, energy and services. This often gets less attention than the cars, but the growth numbers in the sources here are just massive.
Phenomenal is the word I'd use. Revenue for energy generation and storage, that segment jumped 44% compared to last year, hit $3.415 billion. But the truly eye-popping number is storage deployments. Grew 81% year over year. 81%. They deployed 12.5 gigawatt hours of storage.
12.5 GWH.
And importantly, this segment delivered a record gross profit of $1.1 billion. This is becoming a real industrial powerhouse within the company.
And that scale seems driven by new products, like the Megapack 3 and something called the Mega Block. What's the significance of the Mega Block?
The Mega Block is potentially a really big deal for utility customers. It's basically a pre-packaged, pre-engineered system. It integrates 4 of the new Megapack 3 units into one medium-voltage battery system. The idea is it dramatically simplifies deployment for large utility-scale projects, less engineering needed on-site, faster installation. It's all about scale and speed.
And they're building a dedicated factory for this.
Yes, the Mega Factory in Houston. It's expected to start producing these Megapack 3s in 2026, and they're targeting a capacity of 50 gigapage per year.
50 GWH a year. That's also a utility level scale. Like they're aiming to be a major energy infrastructure provider, not just selling batteries.
I think that's exactly the ambition. And related to that, the infrastructure supporting the car fleet is also growing steadily. Services and other revenue, which bundles used cars, insurance, supercharging, parts, all that was up 25% to $3.475 billion. And the supercharger network itself, the number of connectors, grew 18% year over year.
But it's not just more chargers. There's innovation happening there too, right? Moving beyond just charging passenger cars.
Exactly. That's a key development. They introduced the new V4 supercharger cabinets. These apparently have 3 times the power density of the older ones. And crucially, while they can deliver faster charging for cars up to 500 kilowatts, they're also designed to deliver 1,200 kilowatts for the Tesla semi-truck.
1,200 kilowatts.
Yeah, that's industry-leading power for heavy-duty trucks. It clearly signals they intend to build out the charging infrastructure needed for commercial, industrial-scale fleets, not just consumers needing a top-up on a road trip.
Okay, which brings us back to the core technology driving all of this ambition and likely that huge 57% jump in R&D spending we talked about. Let's talk AI and autonomy.
Right. The pace of development there seems to be quickening. They started rolling out version 14 of FSD Supervised in October. And the key thing with V14, according to the documents, is that it starts bringing capabilities developed for the dedicated robotaxi FSD models into the consumer fleet. So improving how the cars handle really complex situations, tricky yields at intersections, avoiding road debris, maneuvering in tight spaces.
And the robotaxi service itself seems to be moving beyond just testing.
It does. They expanded the service area in Austin and notably launched a ride-hailing service, albeit maybe limited initially in the Bay Area. They're using the waitlist feature in the iOS app to manage demand. This is critical, getting real-world miles and data to feed back into the AI development loop.
And to process all that data, they need massive computing power.
Immense power. They mentioned expanding their AI training compute cluster, which they call Cortex. It's now up to a total of 81,000 H100 equivalents.
81,000.
That is a huge amount of GPU power dedicated purely to training these AI models. And related to that, securing the hardware supply chain, they announced that deal with Samsung. Samsung will manufacture advanced chips for their AI inference and training, specifically here in the US. That's a significant move towards securing their own specialized chip supply.
Okay, so lots happening on the AI front. Now, before we get to the wrap-up, we kind of have to touch on the CEO compensation update mentioned in the filings. It sounds substantial. The board granted this 2025 CEO Interim Award back in August. It's, 96 million shares of restricted stock with a grant date value of $26 billion.
Yeah, $26.06 billion grant date fair value. It's obviously an enormous number on paper. But, and this is really crucial, the documents spend quite a bit of time explaining a key contingency tied to that older 2018 CEO Performance Award, the one that's still being challenged in court.
Right, the Tornetta case. So this new award has some strings attached related to that. What does the no double dip provision actually mean in simple terms? Are they just trying to avoid him getting paid twice if the old award somehow gets validated?
That's exactly the gist of it. This new 2025 award acts almost like a placeholder or an alternative depending on the court outcome. It includes this very specific clause, the no double dip provision, linked directly to what the filing calls the Tornetta decision event. Basically, it states very clearly that if that original 2018 award does become fully validated and exercisable because of the court's decision, then the shares granted under this new 2025 interim award will be automatically reduced or even potentially repaid if already issued.
Okay, so the total number of shares he could receive is capped at the level of the original 2018 award, no matter how the legal situation plays out.
Precisely. The documents emphasize the goal is to ensure the CEO receives no material additional benefit beyond what was intended in the 2018 plan. It's basically an alignment mechanism designed to head off any possibility of an accidental or legally forced double payout based on the same underlying performance achievements.
Got it. That makes sense. Okay, and just quickly, before we summarize, the Outlook section did mention ongoing external challenges, right? Things that could still impact cost and demand.
Yes, they were quite upfront about that. They pointed to near-term uncertainty coming from, well, shifting trade policies, tariffs, fiscal policies. They even mentioned potential policy changes, like related to the OBBBA provisions in the U.S. that could potentially eliminate tax credits for consumers. Things like that directly affect their cost structure and, of course, customer demand. So they acknowledge those risks are still very much present in the near term.
Okay, so bring this all together. This deep dive into the Q3 2025 sources really circles back to that core paradox we started with. Q3 feels like a very clear statement of strategic priorities. The company is, quite visibly, accepting that 40% drop in operating income, that significant short-term hit to profitability. Why? To make these huge, seemingly prudent investments, like the massive R&D spend in what they see as the future. AI, software, robotics, they're betting heavily on monetizing the platform, not just selling the hardware.
Exactly. And the sources suggest they believe this transition, this investment phase, can remain self-funding, provided the overall economy supports their core vehicle and energy sales trends. It's like they're trying to build the super intelligent brain and the physical body of the companies simultaneously, and they're willing to let the body's immediate profits dip a bit to fuel the brain's growth.
Which leads us, and you listening, with this final thought to chew on. We see them rapidly expanding their dedicated AI compute power, 81,000 H100 equivalents, the Samsung chip deal. How long will it be before the actual value generated by the AI services, the software updates, the FSD subscriptions, maybe successful robotaxi fleet, the energy software? How long until that value starts to completely dwarf the month-to-month, quarter-to-quarter volatility of just selling physical cars? Are we watching a company fundamentally reshaping itself, where the software and AI value eventually becomes the main story, the tail that wags the hardware dog? Something to think about.